Alrighty, let's go ahead and get started because we have a big week coming up. CPI data being released, guys, December 13th. That's actually today. FOMC right after that. Oof, this is going to be a volatile week, guys, because whatever we see in regards to the CPI data today is going to have implications on how the market expects the FOMC meeting to go. And then based on how the FOMC meeting actually goes is going to have massive implications on how risk assets perform. So what I want to do for you guys is I want to walk you guys through the possible paths that we could take based on what we see happening over the next couple of days. For example, we could see a very straightforward path where markets rally towards the end of the year, or we could see a very painful path where the markets actually sell off towards the end of the year. But regardless of what path we take, we have a very interesting setup at the moment in regards to the macro situation where all paths lead to the same outcome. And I want to be discussing that with you guys. But before we do that, let me go ahead and set the stage, right? I want to talk about what's going on with the CPI, what's going on with the FOMC, and the current status of our yield curve inversions. Now, many of you may not understand what this means, and I'm going to give you guys a quick, simple explanation of why this is important and the implications it's going to have with our risk assets. So let's go ahead and get started. But before we do that, let's go ahead and erase some of our drawings right over here. Get rid of this arrow, get rid of that over here, that over there, and that over there, because I do need the space to be scribbling some more later into the video. Okay, so the yield curve inversions, what's going on over here and what exactly does it mean? As you guys can see, currently we have the 2-year versus the 1-year inverted, the 5-year versus the 2-year inverted, the 10-year versus the 2-year inverted, and as you guys can see, I've added one more to the list down over here, the 10-year versus the 3-month, which is also inverted. But what do I mean exactly by these inversions? What does it mean and why is it important? Well, what we're looking at over here, guys, is the yield being given out by one bond versus another bond. And you're comparing two different maturities, right? So for example, the 10-year versus the 2-year. Let's use that as an example. The 10-year is a bond that will be expiring or rather maturing in 10 years, right? And the 2-year is a bond that is going to be maturing in 2 years, right? So typically, the yield on a 10-year should be higher than the yield on a 2-year, right? So the 10-year should be higher than the 2-year. And why is this? Well, think about it very simply. Let's say I'm lending money to Sherwin, right? Sherwin comes up to me and asks me for $100,000 for 2 years, right? So let's go ahead and write that down here, 100K at 2 years. And I assess Sherwin. I'm like, you know what? This guy is pretty safe with his money. I've known him for a while. Based on all his characteristics, based on the fact that he's a Bitcoin maxi, I am willing to lend Sherwin $100,000 at, let's say, 4% interest rate, right? That's not too high at all. But then, let's say he comes back to me and says, hey, I want $100,000, not for 2 years, but I want it for 10 years. So now I look at Sherwin and I say, you know what? I know Sherwin based on all his characteristics today, but in 10 years, a lot can happen. In 10 years, he could become a shitcoiner. He could start selling all his Bitcoin for Shiba Inu. He can become far more risky. I don't know what's going to happen in 10 years, right? It's very unlikely that he's going to turn into all of that, but I don't know. There's risk. There's more uncertainty leading into the future, right? So a yield curve, guys, right? If you had to draw out a x-axis and y-axis, and your time is on the x-axis, right over here, right, where we go out further in time, here you'll have your 2-year where Sherwin's asking me for $100,000. I'll give him a 4% interest rate, right? But in 10 years, for example, let's say all the way over here, I will ask for, hey, maybe 8% interest rate, right? So I'll plot it over here. So your yield curve looks something like this normally, okay? In an inverted yield curve, your 2-year is going to give you more than your 10-year, right? So for whatever reason, Sherwin comes up to me and asks for $100,000 for 10 years. And I say, you know what? I'm willing to give you 2% for 10 years. Right? And this doesn't make sense, right? Why am I willing to accept less yield for a longer duration? I should be asking for more yield, right? Now, why is the yield curve inversions looked at so closely by market participants? Now, this is very nuanced, guys. And the simplest and quickest way I can explain this to you guys is to say, you should look at your yield curve inversions as the incentive to be a lender. Because think about it, guys. If the yield curve is inverted, okay, and I am lending out money for a longer duration and receiving less, I'm not going to end up lending out money for the long term, right? I'll just end up lending out money for the short term. So lenders are less incentivized to lend on the long term. It means that borrowers are going to find it more difficult to borrow money for the long term, which is essentially tightening financial conditions. Okay, when it becomes harder to borrow money because lenders are less incentivized to lend out money, financial conditions tighten. And tightening financial conditions is a leading indicator for a recession. So now that's a very, very simplified and quick way to understand and look at yield curve inversions for the purpose of this video. But do understand, guys, that yield curve inversions are a lot more nuanced, and we will tackle this topic in more detail in future videos. And by the way, guys, if you are new to the channel, go ahead and hit the subscribe button. And hey, if you have been enjoying the content, go ahead and hit that like as well. It goes a long way in keeping me motivated to keep up this content, because it does take a lot of time and effort to make these videos. Alright, so let's continue. So far, we've established that yield curve inversions lead to tight financial conditions, right? As explained right over here on the right hand side. And thus far, guys, we have yield curve inversions across the board. The 2-year and the 1-year is inverted. The 5-year versus the 2 years inverted. And more importantly, these two inversions, guys, are really, really important to market participants. The 10-year inverting the 2-year and the 10-year inverting the 3-month. Now, I'm not going to go into detail as to why these are very important, but just know that when these two yield curves invert, market participants begin to fear recession even more. And that fear in itself leads to a recession, right? Because as markets tend to often be self-fulfilling prophecies, right? The fear of the recession itself causes the recession. And at the moment, these two inversions have been inverted for a very, very long time. The 10-year and 3-month, I believe, has been inverted for only around a month, which is still pretty long. The 10-year versus the 2-year has been inverted for, I think, around 5 to 6 months, guys, right? So this is the backdrop that we have going into these important days coming up today and tomorrow. CPI data is going to be coming out. And remember, guys, I've said this often, it is the market's expectations that matter more than the actual data that comes out, right? So it's all anchored to expectations. At the moment, CPI is expected to come out at 7.3%. Okay. And based on that expectation, the market is expecting the FOMC to raise interest rates by only 50 basis points as opposed to the usual 75 basis points that the Fed has been raising over the past few months. So at the moment, the market is pricing in a 80% probability that the Fed increases interest rates by 50 basis points. Okay, so that's our two anchors, 7.3% on CPI and 50 basis points on the FOMC. Any surprise to the upside, guys, okay? If you get more than 7.3% on CPI or more than 50 basis points on FOMC, that's going to cause the markets to start throwing a fit. So now what we're going to do is we're going to walk through these possible paths that the market could take based on the outcomes in the next 2 days, right? CPI under 7.3, CPI over 7.3, Fed increasing only 50 basis points, or Fed, hey, surprising and increasing 75 basis points. We're going to walk through all of these paths. I'm going to explain it to you. And we are going to see that regardless of what path you walk down, eventually the trade still leads to the same trade of longing risk assets. Alright, so let's go ahead and start with this branch of the tree right over here where CPI actually comes underneath expectations. At the moment, 7.3% is the expectation. So anything underneath this is going to lead us down this branch of the tree. Alright, so if we get that, we are then likely going to have inflation expectations come down, right? And that's very obvious. Hey, inflation has been coming down for the past couple of months. It came down this month. It came down last month. It's been under expectations for 2 months in a row. The Fed is likely going to increase interest rates maximum by only 50 basis points. And hey, perhaps the following month, right? The month of Jan, we may get hike of only 25 basis points, right? So the market is going to start pricing in lower and lower hikes as time goes on if we continue to get lower and lower CPI reads. As inflation expectations gets pulled out of the market, bonds are going to rally, right? Because remember, guys, inflation expectations directly correspond to bond yields, right? So inflation expectations going up is going to have bond yields also going up because the market is going to demand that the yields match inflation. But if inflation comes down, bond bond yields will come down. And remember what I've taught you guys, bond yields and bonds are inversely correlated, right? So bond yields coming down means bonds are rallying, right? Bonds getting bought up is what causes yields to come down, right? So bonds will rally if inflation expectations come down. So to put that very, very simply, if CPI comes underneath expectations, the bond market is likely going to rally. And the bond market rallying with yields coming down means looser financial conditions, right, guys? If yields are coming down, it means that your mortgage rates are also going to come down, which means you're getting looser financial conditions. So with that said, what's the easiest trade if we go down this path of the tree? Well, it is simply to long duration, to long bonds on the longer side of the maturity, right? So your US 10-year, your US 30-year, etc., etc. But remember, longing bonds will reduce yields, right? Reduce yields is going to loosen financial conditions. And loose financial conditions, guys, is increased liquidity. And I've talked to you guys about this in the past. Markets are all about liquidity. And more liquidity in the markets is good for what? It's good for risk assets, right? So NASDAQ, Bitcoin, hey, even Ethereum. Oh, by the way, guys, over here, ETC does not stand for Ethereum Classic, stands for etc. But yeah, Ethereum right over here. So to summarize this side of the branch of the tree, if CPI comes underneath expectations, anything underneath 7.3%, the trade is very, very simple. Long duration and long risk assets, right? Things like Bitcoin, NASDAQ, Ethereum are likely going to do very, very well. But hey, what about if CPI actually comes above expectations? What then? Well, this is where things get really, really interesting. And this part of the tree, guys, you need to really, really pay attention to. Because even if CPI comes in under expectations this month, next month it may not. Okay. And remember, the Fed has clearly stated that it wants to see multiple data points of CPI coming down. So 1 or 2 months of CPI coming underneath expectations is not going to be enough. If for whatever reason, Jan and Feb starts coming in hot, we are going to be going down this path. So you want to be ready for this eventuality as well. Because even if we get a really, really good CPI reading and the markets do rally leading into the end of the year, we may get a surprise in Jan and Feb before the eventual rally anyways, right? Because I do think that eventually the markets will be rallying no matter which one of these roads we take. So I want you guys to understand what could happen in the middle right over here that could lead to people getting into trouble unless they position themselves well. So let's go ahead and talk about this part of the tree now. Okay, so we talked about how if CPI comes underneath expectations, inflation expectations will go down, Fed is not going to raise more than 50 basis points, etc., bonds will rally, right? But what if CPI actually comes above 7.3? What if it comes above expectations? Well, in that case, we're going to have the Fed doing the opposite, right? Fed is likely going to raise more than 50 basis points, or at the very least, the market is going to expect the Fed to raise more than 50 basis points leading into the FOMC meeting, right? Inflation expectations are going to go up. Why? Because CPI has gone up. So even though last month we got a good CPI reading underneath expectations, this month CPI has gone back up. Markets are, hey, we thought that inflation was coming down, but it's not. Oh no, what if Jan is going to be worse as well? What if inflation keeps going up and up and up? So at that point, market expectations are going to start going up in regards to inflation. Fed is going to also have to step in and increase interest rates to curb those expectations. And that's when we're going to go down these two paths, right? And this is where it gets super, super interesting. What happens if we start seeing the Fed raise interest rates higher than 50 basis points, right? What if we get 75 basis points 2 months in a row? What if we get 75 and then 100? I don't think that's going to happen really, but we could get a 75 and then another 50, right? Fed could start increasing far more aggressively than the market currently is pricing in, and that could cause a lot of pain. So let's go down these two paths. One path is the market starts beginning to think that, hey, the Fed is raising interest rates way, way too much. We are going to break the market at this rate. We are definitely going into a recession. And what does the market do when it fears a recession? They buy bonds, right? They buy long duration bonds, especially at the current yields, guys. These yields are very, very attractive. Wouldn't be surprised at all if the market jumps into bonds if they start fearing a recession because the Fed is going to break the market. Okay. And we've been hearing market commentators for a while now, for like almost a year, saying the Fed is going to raise until they break the market. The Fed is going to raise until they break the market. Well, if the market gets surprised on the higher end with CPI, right, and they expect a 75 basis points raise suddenly, well, they're going to be afraid that the market is going to break, which is going to lead to a recession, in which case they're going to buy bonds, which is going to do what? It's going to bring yields down, which in turn loosens financial conditions, which is good for what? Which is good for risk assets, right? We discussed that right over here on this part of the tree where CPI had actually come underneath expectations. So over here we are seeing that even if CPI comes above expectations, provided the market expects the Fed to break the market because of that, we are going to end up in the same part of the tree, which is long risk, okay? Now again, that's provided the market expects the Fed to break the market. But what if the Fed is not expected to break the market? What if the market thinks that, hey, you know what, the Fed can raise to 75 basis points and we'll be fine. Bonds will sell off, right? Because remember, on this part of the tree, guys, right over here, when CPI came underneath expectations, the market expected bonds to rally, right? That made sense, right? We explained why. Over here, it's the opposite, right? The market is going to expect interest rates to go up, so bonds need to sell off to be able to match those inflation expectations, right? To match that yield. So bonds sell off. What's the trade when you're expecting bonds to sell off? You just short bonds. Very, very simple. Similar to this trade over here. You long bonds when you're expecting bonds to rally. You short bonds when you're expecting bonds to sell off. But here's where it gets really, really interesting. If bonds sell off, guys, right, because the Fed is raising interest rates, the yield curve inversions that we discussed at the beginning of the video, they are going to deepen. You're going to get a deeper inversion. Now, why is that? It's because when the bond market sells off because the Fed is raising interest rates, the front end of the curve is going to be more sensitive than the back end. What do I mean by that? Well, essentially, let's say we're comparing the 10-year and the 2-year. The 2-year is the front end. So the 2-year is going to sell off more than the 10-year. That's what I mean by the 2-year being more sensitive than the 10-year, right? The front end being more sensitive than the back end because the Fed has more control over the front end than the back end. So what's going to happen to the front end? The front end is going to have a higher interest rate, right? Because remember, the 2-year is being sold off more. So the yields of the 2-year will go up and up and up, and it's going to go up faster than the 10-year, which is going to deepen the yield curve inversion. And we already established right at the beginning of the video, guys, that yield curve inversions tighten financial conditions, and tightened financial conditions lead to recessions, right? Which often is a self-fulfilling prophecy because the fear of recession leads to a recession. So what do we end up with on this side of the tree then? If the Fed raises interest rates by 75 basis points and the market is not expected to break, we are going to get bonds selling off into a deeper inversion, which is going to lead to recession fears, which is going to lead to what? Recession fears always lead to a flight to bonds, especially at the current interest rates that are very, very attractive. So you long duration, right? I don't know why that's missing right over here. You long duration, which leads to furthered decrease in interest rates, which improve financial conditions, which improve liquidity, which improve the conditions for your risk assets, right? Now, this is a longer path to a long risk asset trade, guys, but it is still a path, right? Which is why I think that we have to be very, very careful for the next month or two, okay? Regardless of how CPI data comes out in the next, I believe, next few hours. If CPI data comes out lower, we will rally for the next few weeks at the very least, right? We'll get a good rally. But the next couple of months, you need to be very, very vigilant because if CPI data surprises, we are likely going to see a sell-off, okay? But you cannot get shook out of the market because the eventual trade is still here. So if you position yourself for the longer trade, okay, 6 months, 1 year, etc., you'll have to make sure that you are able to sit through the pain in case it does come. At the moment, all paths do lead to a long risk asset scenario, right? But how we get there is going to be dependent on the current CPI read as well as the next month CPI read. So keep in mind, don't get too greedy. We are almost at the end of the road of this bear market and this Fed tightening cycle. This also lines up with what we've been talking about over the past few weeks, right? We had many, many charts that are all lining up to the fact that we are likely going to start seeing the rising bull market phase in the next 6 to 8 weeks. We are getting ever so close. And guys, if you are new here, right? Again, remember, please subscribe and go ahead to our channel and watch the previous videos, because everything we're discussing is only part of a larger puzzle that we've been putting together over the past few weeks. All right. So if you enjoy this content, please let me know in the comments down below, guys. Again, your comments have been so freaking motivating. Thank you, all of you, for the comments. They keep me coming back here. So I'm looking forward to reading them, and I'll see you guys in the next video. Do the mango way, do the easy way.